let's have a look at where we stand with the world economy and the corona effects, and also the latest on regulation. And that is with nobody less than Dr. Joseph Stiglitz, a Nobel Prize winner in economics from 2001, and currently the chief economist at the Roosevelt Institute. We have pre-recorded his presentation because he is based in the States. So let's listen in on what Dr. Joseph Stiglitz has to say.
It's a real pleasure to be able to share some of my thoughts about the evolution of our global financial regulatory system. We've had two major crises in 12 years, one in which the financial sector was at the center. That was the global financial crisis of 2008 that began in the United States. The other was a pandemic. But with many companies going bankrupt, the financial sector almost surely will be affected. And the extent to which it is affected will depend on the strength of the financial sector before the pandemic. And then there's the third crisis, the climate crisis that looms going forward. The effects of that climate crisis are now being felt in the United States. We've had wildfires, forest fires in California, hurricanes, floods. The devastation to our economy is significant. Some estimates as much as 2% of GDP. And this is not the first year that we've experienced losses of that magnitude. Losses that put obviously a strain on insurance markets. But even going forward, there is even a greater risk, and that's a risk that's sometimes called the transition risk. There are large amounts of assets, fossil fuel assets, that are at the risk of becoming stranded assets. The value of those assets may fall precipitously. And with in an interdependent financial system, that could have large systemic effects. Markets don't always adequately reflect the future. They don't always see very far into the future. Even a few years before the 2008 crisis, there was little glimmer in the financial markets of what was in store. So there are three questions that I want to talk about today. The first is the adequacy of our regulatory system, particularly in dealing with systemic crises. And all three of the crises that I've just described are systemic. It's not just one financial institution that will be affected. It's our whole financial system, and in fact, indeed, our whole economic system. The second question is the harmonization of our regulatory system around the world. We are interdependent. What happens in one part of the world does have effect on the others, as we saw so clearly in the 2008 crisis. And so the question is, to what extent have we achieved that kind of regulatory harmonization, the kind of regulatory harmonization that we need for global financial stability? And the third is the timeliness of the provision of data. Timeliness for the regulators and the supervisors to give adequate and timely responses. And so let me take up each of these questions in turn. In terms of the adequacy of our regulatory system, I think most observers would say things are clearly better in most dimensions than they were before the 2008 crisis. But they are still not adequate, and they're particularly not adequate from a systemic point of view. To assess that, we need detailed information about the interlinkages, the interdependencies, both the direct and the indirect. And we don't yet have the kind of full data set in a timely way, and I'll come back to that later, that we need to make those assessments. Things can change very rapidly, which is why it's particularly important, timeliness. What happened in the aftermath of the collapse of Lehman Brothers illustrates what I'm talking about. My own research that I had undertaken, beginning with the East Asia crisis, and then in the early years of this century, had called attention to the importance of these interdependencies, where the failure of one company or one financial institution had consequences for others. In the case of the East Asia crisis, it wound up that 50% or more of enterprises in Thailand, in Indonesia, in Korea were not able to pay what they owed. There was systemic distress. There was actually only one central banker around the world who emphasized the importance of these, understanding the interdependencies, who paid attention to this kind of systemic risk. And that was Andy Haldane, who was the director of research at the Bank of England. Remarkably, we still haven't explored fully the systemic nature of the carbon risk to which I alluded earlier. Carbon risk is in many ways more complicated because it's more pervasive. The linkages are more complex. We've begun to do a better job of exposing individual carbon risk. That is to say, the extent to which any firm itself has carbon risk on its balance sheet. But we haven't really done an adequate job of exploring systemic carbon risk. Many of the central bankers have grasped the significance of this, and they have gotten together to try to push this agenda of identifying, assessing the nature of systemic carbon risk. Unfortunately, the largest, most important financial center in the United States is not part of that effort so far. But this is one of the areas where I am hopeful that a change in administration in Washington will make a difference. I believe that the technocrats are aware of the significance of this risk. And in the right political climate, they will begin to do the work that is necessary to enable us to do a better job in assessing this risk. Let me come to the second topic, which is harmonization. The global financial system can only be as strong as the weakest link, or at least the weakest important link. And there have long been worries about a race to the bottom, what's sometimes called Gresham's Law, where bad regulation drives out good regulation. It always used to be heard that we can't tighten our regulatory standards because we will be undermined by competition from elsewhere. Well, I think we now know that that kind of reasoning is foolish, that a country that doesn't adequately address its risk, that participates in this race to the bottom, is likely to pay a high price. But there should be efforts to avoid this race to the bottom and actually have a race to the top, to have the highest standards. And some countries have done well by advertising, by making a big deal about the fact that they do have a regulatory system that is stringent. That makes the financial system more stable. But there's one aspect of this where I think we haven't gone anywhere near far enough, and that is the secrecy havens. They've been tamed, but far from eliminated, and that's in spite of all the attention that's been focused on them from the Panama Papers and the Paradise Papers. And these engage in a broader set of harms than the fact that we can't adequately assess systemic global risk, because we reach a dark spot in our map of what is going on. The broader harms include things like tax evasion, money laundering, a whole host of harms to our society. The good news in this area is that the digital platforms, the global digital platforms, should make it easier to see what is going on globally. And if not to achieve full harmonization, at least for us to assess the weaknesses in the regulatory regimes in various countries and to take actions to appropriately compensate for those weaknesses. On the other hand, there is something that has been of increasing concern to many regulators, to me, and that is the growth of the cryptocurrencies. For years, you might say for decades, the financial systems have been working to create more transparency in the belief that more transparency will lead to a more stable global financial system and a financial system in which some of the harms, money laundering, nefarious activities are circumscribed. But in spite of all these efforts at more transparency, the cryptocurrencies are going in exactly the opposite direction. They're trying to make things less transparent. And you have to ask, who wants to engage in that kind of secrecy? Well, people who are engaged in nefarious activities, people who are engaged in activities that might represent a risk to the global financial system. So we need to focus on regulations that circumscribe these cryptocurrencies. And I think that can be done. That can be done by particularly focusing on the interface between cryptocurrencies and the regular financial system. In general, in order for individuals to buy goods and services, for corporations to buy goods and services, the cryptocurrencies have to be converted into ordinary currencies. And that is the point where we need to focus attention. And that's where the regulation has to be particularly stringent, where we have to call attention to where is the money. Just like you can't deposit money into a bank account without knowing your customer, there has to be transparency in those deposits. It becomes particularly important to have those same kinds of principles in transferring money from a cryptocurrency account into an ordinary account. More broadly, I think the international community should be working to shut down these cryptocurrencies, which have been encouraging a whole variety of nefarious activities. As in so many other areas of global cooperation, the last 4 years has been very difficult in developing cooperation in the regulatory harmonization. Again, this is an area where I think the next 4 years may be very different. There is an awareness of the need for better cooperation and better regulation. Some of the advocates of deregulation that have populated the current administration occasionally have had to ask them, have you forgotten about the 2008-9 crisis? Have you forgotten what happens when you have an under-regulated economic system? Have you forgotten the damage that it can do to our economy, to the global economy? And it seemed that it was a conscious amnesia. They didn't want to remember. Well, we shouldn't forget. And as I said in the first part of my remarks, we need to have a stronger regulatory system. Things are better. We need more. And we need to do this better regulation together in a harmonized way around the world. And that brings me to the third topic, real-time data. What has happened in response to COVID-19 is heartening. Nothing's been like it. This crisis, of course, occurred at a speed that we've never seen anything like it. The increases in unemployment, the collapses in GDP, they have been unprecedented in magnitude, but even more unprecedented in the speed with which things have occurred. Our normal way of reporting data is just not up to the task. Normally, we report the data the previous quarter. We wait a few weeks to get our first estimate, and then we get a second estimate. And by the time that happens, the COVID-19 is on to another phase. We may have gone from a lockdown to an unlockdown, back to a lockdown. We may be in the second wave or the third wave. The timeliness of the data of our data system prior to the pandemic was unsuited for dealing with the pandemic. But fortunately, there were a number of data platforms that enabled us in real time to see what was going on. These were advances that we have had actually begun before the pandemic. There were a number of attempts to scrape the internet, to infer from real-time data on the internet what was really going on in the economy. And these real-time analyses were actually remarkably accurate. In fact, they provided a better forecast of the revised GDP data than the initial GDP data, the preliminary GDP data that the Department of Commerce was coming out with. And this real-time data has been enormously valuable in helping us understand what has been going on in COVID-19. let me just give you a couple of examples. One of the things that was very striking was the bifurcation of the population, with half the population living hand to mouth, paycheck to paycheck. What we saw from the real-time data is that the day or the day after they got a paycheck from the government, their spending increased. They were constrained even in spending money on food by the lack of money. And the assistance we provided was invaluable. On the other hand, for the upper part of the distribution, precautionary savings increased enormously. The average savings rate in the United States, normally around 2, 3, 4, 5% of GDP, soared in the second quarter to 25% of GDP. The reason? People were uncertain. They didn't want to spend money on activities that represented a threat to their health. And the two effects together led to unprecedented savings rates. Well, what that highlights is that in confronting a disease like the pandemic, we need real-time data in order to know how to respond adequately. And part of knowing how to respond is knowing how to target our money, to whom we should allocate the money, to what sectors, where is the real points of vulnerability, who are the people suffering. All of this is data that we now have available. Never could have done this, just like we couldn't have done Zoom 20 years ago. We never could have gotten this kind of data 20 years ago. The new technologies really have provided us with more information with which we could manage our economy so much better. Now, of course, there would be even more data if our platforms were more competitive. The reason why I say that is that in some countries, there's a lot more reliance on digital transactions than in others. One of the major impediments to the use of digital transactions is the cost. And the cost is not because of the real cost of the transaction. That's a fraction of a penny. The cost is because of the market power associated with some of the use technologies that allows them to charge fees on merchants that are incommensurate with the cost of the transaction. Some interesting experiments in Asia where that cost has been really brought down to zero. And that should lead over time to almost all transactions being digital. And as more and more transactions become digital, our ability to monitor the economy will increase enormously. And that means not just in times of pandemics, but more generally, we will be able to have better macroeconomic management. Today, macroeconomic management is almost inevitably looking in the rearview mirror. We talk about, for instance, in the context of monetary policy, long and variable legs. But as the central banks, Federal Reserve, are making decisions, it typically doesn't have current data. It has data from 6 weeks ago, sometimes 12 weeks ago. It's even when they have last quarter's GDP, the data may be revised substantially. The digital platforms have the potential to give our macroeconomic regulators the data with which they can help regulate our economy in a more effective and a more timely way. There are some challenges in all of this. Not because real-time data can be just as accurate and more so, it could be a better predictor of revised GDP. The financial system has data that's important for assessing both financial stability and macro stability. But the challenge is to make it secure, maintaining privacy, a task that I think that there's been a lot of progress. A lot of people say that we've actually have, at least at the moment, a reasonable degree of success. There are other challenges, again, surmountable, the aggregation of data from different sources. So all of this holds out the promise of a much better fine-tuning of macro management, more macro stability, more financial stability. This rich data set can enable both regulators and financial institutions to assess better risk. The implications for the standard banking structure are not yet clear. Risk assessment is still a challenge. Models based simply on connecting potential borrowers to potential lenders through internet banking could impose great risk on the system. That in those models, there's a lack of risk assessment. But models based on using the rich data set to make better forecasts of creditworthiness do make sense. Here, the problem is not only the preservation of privacy and security, but concerns about the concentration of market power. Will the market become dominated by those who can amass the largest relevant databases? Regulators will thus need to not only have to have access in real time to data, but have full knowledge of with whom what data is being shared and whether the storage and use of data complies with a regulatory structure designed to maintain privacy, individual rights, competition, security, as well as financial stability. The challenges for financial regulation in the coming years are enormous, but the opportunities of using this new data to have an economy with greater financial stability and greater macro stability are also enormous, and the prospect, therefore, for the well-being of our societies are very great. Thank you for this opportunity to share some of my thoughts on these issues with you.